Welcome everyone. My name is Greg Diamond, and this is Diamond's Edge Live, a new show. And I'm just going to get started with a few slides to start, kind of go over a few basics. Um, let's see here, sharing screen. It's not working. Let's see. Let me try one more time. All right, this isn't working here. Off to a good start. There we go. All right, so goals of Diamond's Edge Live. Okay, we can talk about timely things when they're happening. We can look at different trends, different volatility when it happens. Okay, but what I'm going to start with is something that anybody can use. Okay, and the good thing about my strategy and what I'm going to show you is, you know, it'll go to something that you may like or you may not like, but anyone can use it. Okay, it really depends on how risky you want to be. It will depend upon how active you want to be. Okay, so some of the goals that I want to achieve with this show are the technical trading strategies, and that is day trading, and that can be futures, that can be options, that can be stocks on margin, it can be ETFs. Okay, please understand that I cannot give you actual recommend any live trades. Okay, I may show you some trades that I have done, in my personal futures account. I may show some trades that we've done, with our 10 stock trading service, but I cannot give you actual live trades within this show. Just something to keep in mind. And then, in terms of the day trading, if that's something that you want to do, if you want to be that aggressive, great. If you're not, we can look at the swing trading, larger time frames. And that's really what I use in terms of my strategy for 10 stock trader and the subscribers who follow me there. And then, we're going to be looking at all things technical analysis. Okay. So when we look at what technical analysis is, when we look at the strategy itself, what I like to call the three tenets of technical analysis, and that is time, which is Gann analysis, and Gann means W.D. Gann, a famous trader who lived a long time ago, but he came up with how time cycles, short term, long term, and everything in between, how that factors into trading. Very important. Okay. Then price. And I'm going to cover the majority of this show, the first show, with Elliott Wave Theory. And Elliott Wave Theory gives you a roadmap, okay, for how prices behave. All the little squiggles on the lines, what does it exactly mean? We can formulate that into a pattern, and that pattern is Elliott Wave. And then to use with time and price, we use indicators, momentum indicators. Many people have heard of the RSI, the MACD. There's tons and tons and tons of momentum indicators out there. Within 10 stock trader, I like to use the RSI, relative strength index, and I like to use something called the composite index. All right, and I'll get to those today as well. All right, so what I like about technical analysis is that it can be used on any time frame. Okay, especially when you're talking about Elliott Wave and the indicators, whether you're using a 1 minute chart, whether you're using a 1 year chart, 1 month, 1 week, whatever it might be. It's interchangeable throughout time frames. That's very important. Um, so that's something that, again, is a very big part of the strategy, is understanding the different time frames. And if you're going to be in the day trading business, if that's going to be your strategy, there are lots of tradings. You have to use stops. And an important part of using stops, and I'll get into this, is, okay, when I put in a trade, I'm automatically going to put in where my stop is going to be as soon as I put it in. Okay, and what's useful about this strategy as well is, let's say you want to be a little bit more conservative. I'll get into how that works versus also being aggressive. And basically, being conservative within the framework of Elliott Wave means I'll let the market get me in. If the market comes to this certain level, then I'm going to get into the market or out of it. Or if I want to be really, really aggressive, I'll look to buy low and sell high, and this will all start to make sense. One of the things, when either if you're a seasoned trader or you're just starting out, everyone kind of has a different way of doing things. It might feel like you're drinking out of a fire hose. I understand. But over time, it'll start to make sense. It will also help you understand, where you fall within, one of these strategies. Okay, do I want to be a day trader? Is that something that I want to commit to? Am I going to look for longer term stuff, more swing trading? So that will all come to, if you kind of get lost within the first couple shows, stay with it, because I think what you're going to find out is how you look at the market and what's best for you. Okay, so just a few rules. I'll have more of these with every show, but I think the mental aspect of trading is just as important, if not more important, than the strategy that you have. And I just kind of mentioned it. Patience. Okay, you're going to figure out what you like, what you don't like. Trying to understand the dynamics of Elliott Wave, trying to understand the dynamics of Gann can be complicated. Sometimes it's simple, and that's great when it's simple. Everything's flowing. It sounds great. It looks great. You're just in rhythm with the market. Other times it's not. That's part of the game that we play. So just have patience when it comes to trading. A lot of people, want to be a millionaire overnight, and then they do things that they shouldn't. They get impatient, and that causes losses. So patience is very important. Risk management is probably the most important. Okay, I mentioned it. In terms of the day trading. Always put in a stop loss whenever you enter a trade. Always. A lot of people get lost in or lose money in day trading and investing in general is this hope. Well, I hope it turns around. It'll turn around. I know it will. No, you don't. That's where people get in a lot of trouble. Okay. And I talk about this with 10 stock subscribers a lot. That losing is part of the game. Nobody wants to admit it. Nobody wants to talk about it. No one goes into the day saying, man, I just can't wait to lose this trade. Of course you don't do that, but it happens. So once you understand that mindset, okay, that mistakes are going to be made, losing is going to happen. Nobody is right 100% of the time, all day, every year for the rest of their life. No one, ever, okay? So if you have that mindset, once you understand that losing can be incorporated into your strategy, it makes it easier to accept it. Professional traders don't get bothered by losses. They understand that it happens, okay? And then, I mentioned this a lot with 10 stock subscribers is, always focus on what's next. Yeah, we lost this one. Okay, it stinks. Let it go, okay? Always focus on what's next, because I guarantee you, and this is the other thing, people get down on themselves. They feel sad. They sulk. Oh, we lost this. We lost that. You're wasting energy on what was and not what is. Not what is going to be. There's always going to be another trade. Always, 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 always. Unless the market's shut down for some reason, okay, you're always going to have another trade. So think about that. Another important thing, a rule to go by, and this is really just with day trading. This is something that, there was a professional trading shop that I had looked into, okay, and basically what these prop shops do all day, every day, is they trade the day as if it was a month or a week or a year. Okay, and so what they're doing is they're eliminating longer term time frames, and they just want to focus on a strategy. And I'll show you what that strategy is. Okay, but they have a daily goal. Let's say it's $1,000. If I make that $1,000, I'm set. But on the flip side, they'll have a losing day dollar. So if I lose 500, all right, I got to step back. Or reduce my risk. So day trading goals are very important if that's something that you want to pursue. And then swing trading goals is more aligned to what I do at 10 Stock Trader. We will trade within a day or in a couple of days for sure. If the volatility suits, if the environment is there for that. So far in 2025, we've had five winning trades. Those have been pretty short term. But I'm looking, as I'll explain, we're looking kind of farther out into March and April for when I think things are really going to start moving here. So swing trading takes a little bit more time. So also, please like and share, like and subscribe. Tell your friends. The more interactive this becomes, the more fun it's going to be. I'll take questions at the end. So I think this is going to be an exciting show, and hopefully we get some following, and we can and be more interactive. You can see what it's like as a professional trader each week. Okay, so let's go to the charts, and what I want to show you is so these are a few things that I have on my screen. There's a whole another side that you can't see, but you can see here I have six charts up. Okay, what I'm going to start with today is I'm just going to start with the basics of Elliott Wave. We'll look at some of the indicators. We'll look at the composite index. We'll look at the RSI. We'll cover divergence. We'll cover reversals. Okay. Some of this, if you're a 10 stock trader subscriber, you're probably going to be used to it, but it never hurts to kind of go back to the basics and see what we're looking at. It also, I think, helps to see it in real time and not necessarily as I posted on the app or website or wherever you might see it. So let's start with Elliott Wave, okay? And the basic level of Elliott Wave says that prices move in a series of 5 waves and 3 waves, okay? So if you're looking at an uptrend or you're looking at a downtrend, whatever is the primary trend, that will be a series of 5 waves, okay? 1, 2, 3, 4, 5, and then you have a reaction, ABC, of 3 waves, all right? So before I get into this, if you want to learn more about Elliott Wave, I highly suggest you buy the Elliott Wave Principle by Frost and Pretcher. Not a long book, maybe 100 pages or something, but it goes over the basics of Elliott Wave. Now the basics kind of turn into more advanced patterns and situations. We'll get into that, but again, for the first show, I'm just going over the very basic fundamentals of Elliott Wave Principle. All right, so 5 waves. And you'll see in Elliott Wave Principle by that book that it tends to be you'll just see like these drawings. Okay, that's great. It helps you understand the basic principles of it. I like to use real-time charts. I like to use what has actually happened. All right. So this is the S&P 500. This is going back to the top in 2007, right before the great financial crisis. We all know what happened, okay? But the reason I like to do it, the reason I like to look at it, is Elliott Wave really tends to work extremely well when markets are moving, whether that's up or down. It really tends to stick out to you when there's fear, and that is obviously in a downtrend. You can see it in this 2007, 2008. You saw it during COVID, a bunch of other times. All right, so let's get into this, okay? So we can expand out, all right, but I want to show you, okay, this is again the 2007, 2008, all right. Now let me zoom in, and this is just the top back in 2007. Okay, this is a daily chart, so each bar represents one day, all right. So you can see here I have this wave 1 down, this wave 2 up, wave 3 down, wave 4, wave 5. So that completes one move, all right. Now there are 5 waves within different waves, but you can see here, this is what's important, especially for the day trading, especially for swing trading, okay? After 5 moves, what are you likely to expect? Based on the rules of Elliott Wave, 3 waves up, or 3 waves in a counter trend, okay? In this case, since this move was down, we have this ABC, all right? So, seems simple enough, okay? This is also where you get a lot of criticism about Elliott Wave. Well, Greg, it's very subjective. Yes, it is. Subjective meaning, well, it's up to the analyst to decide, well, is this a wave 1? Is this a wave 3? Is this a wave 4? This is where it's important. And I go back to Paul Tudor Jones, famous trader, hedge fund trader. My first boss worked for him. And he said something that I think is very important about using technical analysis, but especially Elliott Wave. And he said it actually in Market Wizards book by Jack Schwager, another book I highly recommend that you read if you haven't. And basically what he said is Elliott Wave, the great thing about it is it is both a risk management system and a trading strategy, okay? So what we're looking at here is, what does he mean by that? Risk management and a trading strategy. The trading strategy is, hey, look, let's use it right here, okay? So if I'm just focused on what happened here and not looking 20/20 hindsight, okay, we had this wave 1 down. Now, if I'm thinking about, okay, where do I want to place my trade, right? If I think that, let's say you go back and you're Michael Burry, whatever, and you know that the housing market's going to crash, okay, and you're like, I'm shorting everything. But after this 5-wave move down, I really want to short bounces, okay? This is where the rules come in. This is where risk management comes into play, okay? And a trading strategy, exactly like Paul Tudor Jones said. If I think that this is the wave 1 down, okay, and I get this bounce, this wave 2 rally, this is where I'm shorting, okay? But guess what I'm doing here, okay? This is where risk management comes in. If this counter trend rallies above this first wave, guess what? You're wrong, right? That defies the rules of Elliott Wave, but it protects you. This is where your risk management system comes in. This is exactly what Paul Tudor Jones is talking about. That's why I think this is so important, okay? So, and look, you're gonna have times where, all right, I think this is a wave 1 down, so you put your short in there, okay, and then it breaches above it. You stop, you get out. This is where you understand you're losing. All right, let's take a step back and reevaluate. Another interesting quote from Market Wizards, and I believe it was Bruce Kovner, but he said something to the effect of, I've learned to trade where I'll be wrong. I'll be wrong the first time, I'll be wrong the second time, I'll be wrong the third time, and then I'll double my money. That's also interesting as well. Number one, it goes into, I'm not worried about the losing as long as I'm putting my stop in, okay? And I'll do it again, and then I'll do it again, and then boom, and then you hit a home run. Now, you can't have that. You can't lose 10 times in a row, and that's not good, okay? But this is, again, where the rules of Elliott Wave come into play. It's going to protect you. That's what's so wonderful about it, I think. And again, just going off of what Paul Tudor Jones says, I think it makes a lot of sense, okay? All right, so let's say you get that right. All right, so you have this wave 1 move down, you have this wave 2, and now, based on the rules of Elliott Wave, the third wave is usually the biggest. Sometimes it's the 5th wave, but usually the third wave is the biggest, okay? And then we have this big third wave move down, 5, 4 up, and then the 5 down, all right? So now let's expand out. And you can see how this keeps going. 1, 2, 3, 4, 5, correction, A, B, C. All right, now let's expand even more. Look what happened here. This is when we started to get into 2008. All right, you can, and I'm not going to label this, but I want you can see it for yourself. 1 down here, okay? You can follow my cursor. 2 up, 3, 4, 5. All right, now look. This is where it gets a little tricky. So this is a daily chart, okay? Within the 5 waves or 3 waves, whatever it might be on a daily chart, you can go to a 1-minute chart, and I'll do this a little bit later. But there are waves within waves. So if you're looking at this like a puzzle, it's saying, okay, we have this wave 1 move down, this wave 2, where are we looking at in the bigger picture? This is the bigger picture. All right, and then you can see this. So these are kind of hard to see actually. So let me delete these real quick, and I'll show you the bigger picture and how this whole thing played out exactly like Elliott Wave said it would, okay? All right, so as you can see, I'll get rid of these. This is the entire great financial crisis expressed in Elliott Wave terms, all right? So 1, 2, and then you can look, let's zoom in here on this 1 move down, okay? And then you can kind of see this overlapping pattern, 1 A, B, C, into this wave 2. And that was a massive wave 2, because then we had, Lehman Brothers, the AIG, I mean, you name it. We all know what happened, right? That was the middle of the crisis, but we know that this is a wave 3 down, okay? We had the wave 4, the wave 5, and then that bottomed. The Federal Reserve printed gazillions of dollars, banks were bailed out, the whole thing, all right? But this is expressed in Elliott Wave. Now, what exactly is Elliott Wave? What are we looking at? What does it actually mean? How do these rules get formulated into, what's being expressed on the chart? Well, technical analysts believe, and I certainly do, that the price action that you see is human emotion, in this case investors, expressed on the chart, okay? And those happen in repeated patterns. That's what's important, and it happens over and over and over and over again. There's a really great movie called Margin, and it's a fictional movie with fake characters, a fake bank, but it's based upon the Great Financial Crisis. And at the end of the movie, I won't go over the whole thing, but the CEO of this huge, he's a billionaire of this huge bank. Basically, he talks about all different panics that have ever happened, tulips. He goes through the whole thing, 1929, blah blah blah, and he said we just can't help ourselves. We do the same thing over and over and over and over again, and he's right. And the great thing about it is that you can see it expressed on the chart, and that's how you can profit off of it. Okay, again, doesn't mean you're going to get everything right. Doesn't mean that it's always easy. But going back to what Paul Tudor Jones said, this gives you a framework for how to manage risk, and it's a trading strategy. Now, some people only rely on Elliott Wave to get to where they want to go, and that's where I expand my strategy using time with Gann and then the indicators. Okay, all right. So this is the bigger picture. We kind of went over some of the simple details, which are important to get a framework of the basics of it. And this would be more of a swing trading type thing, right? We're looking over the period of a couple years. All right, now let's dive down into the day trading aspect of Elliott Wave. How exactly would I be a day trader, and what would I do? Well, I can show you. And I put a lot of time into 10 stock trader, so I don't day trade. I certainly don't trade anything that I recommend in 10 stock trader. I personally trade futures. Number one, it's faster, it's quicker, and it's kind of second nature. I don't day trade every day. I just don't simply have the time because I'm too busy doing research and then looking for future trades for 10 stock trader subscribers. But what I do like about it is that it keeps me honest, meaning, hey, if I'm going to trade this in the futures account, whether it's short term, long term, whatever it might be, then I want my subscribers to take part of it as well, and I'll parlay that into our options trade or ETF or whatever we're going to trade. So I think that's important. All right, so if you're going to day trade, this is a setup to use. All right, now I'm using futures. You can use this is NASDAQ futures. If you want to use the Qs, by all means, XLK, that by all means. But what you should have is, and I'll go over the specific charts that you should look at, okay? But I like to look at a 1 minute, 1 day, which is exactly what this is, okay? A 30-minute, 1 month chart, and a 120-minute, okay? So I have a very, very short term, 1 minute, 1 day, shorter term, medium term, longer term, and basically what I can see is I can see how the patterns are developing. What patterns? Elliott Wave. I look at this all day, every day. Look at it at night when I'm awake. If I can't sleep, I look at it constantly. And what am I doing that? I'm trying to understand the building blocks of Elliott Wave. What is the market telling me is likely to happen next? What are the probabilities that it's going to tell me that are going to happen next? Okay, so let's just look at this real quick. Okay, and this, again, I like looking at live stuff. You can see market's moving here. It's 123 here on Wednesday. It hasn't been too active. I think markets are looking forward to what the Federal Reserve minutes were tomorrow, as well as more inflation numbers later this week. All right, but what can we gather from what happened in this futures chart? All right, this is going back to yesterday. All right, can you see? And again, 1 minute, 1 day. Right. Look at how this shapes out into a series of 3s and 5s. And once you start getting used to, looking at this, all you'll see, or all you'll want to see, where are the 5s, where are the 3s? Where are the 5s, where are the 3s, right? And then you'll have to decide, okay, do I want to trade wave 1, wave 2, wave 3, okay? And we'll get into that right now. Meaning, so let's fast forward to today, all right? So you have, this is when the market started opening, okay? To me, and I'll label this live, okay? I'll do this right now. And we'll see exactly how this would look if we were going to trade it as a day trader. Again, I can't give you live trading recommendations. I'm just saying this is what it would look like, okay? So you have this big spike down. This looks like a 1, 2, 3, 4, 5, and then look, A, B, C, okay? So where would you put your stop? If you wanted to get short here at 2, right, you would have had this big wave 3, you would have put your stop up here, right? That's simple. All right. Now, if it were to rally up, all right, I got to start over again. This is not what I'm looking for. This is not what I thought it was going to be. It's not a wave 1 down. It's something else. I got to back off. Okay. Now, at the beginning of the show, I mentioned now you can either get aggressive or you can get conservative. What that means is if you want to get aggressive and you know that this is a wave 2, or you think it's a wave 2, the probability suggests this is a wave 2, you can start selling up here, getting short, okay, and then looking for that big move down. If you didn't want to do that, if you wanted to be more conservative, where would you put your entry port to get short? You know that this is a wave 1, this is a wave 2, or you think it's going to be. If you wanted to get conservative, you would put a stop market order to sell short right here. And look, you would have made money, right? Because you got short and then it traded down, you know, and you could have covered anywhere in here. Again, this depends upon your daily goal, whatever it might be, all right? But either person, whether you're aggressive or conservative, would have made money. The guy who wanted to, or the gal who wanted to short up here would have made a little bit more because they got more aggressive. But the person who was going to be conservative and say, you know what, I want to make sure that this is a wave 3 down, the market would have got you into that short, and you would have seen that nice decline, and then you can focus on where you want to cover. But that's a really good, real example, really, of where you can get aggressive or not, depending on how you wanted to trade this market. So again, this is a 1 minute, 1 day. This is as short term as it gets, and you just do this. The prop trading shops, the hedge funds, the millenniums of the world, all these guys who are very, very short term oriented, this is what they do all day, every day. They have a daily goal, they're getting aggressive or they're getting conservative, okay? And then they're looking. It's a lot easier when markets are moving fast, but this is why they trade these very, very short term, because even if it's not moving, they can still have that daily goal that they can reach, okay? And they get a percentage of everything they make, and it's a profession. That's exactly what they do. So day traders get a bad rap, and I understand that, but what people don't realize is that on Wall Street, they're everywhere, okay? And they're doing this all the time. And they make a very good living doing it because they have these risk management principles set in place. They have these strategies. I'm not saying that they use this exact thing, but it's similar, okay? All right, so that was a 1 minute, 1 day. Let's look at, let's see. All right, so you can see here, I got a 1 minute, 1 day. Here's a 30 minute, 30 day, okay? And so it's kind of hard to see on this screen shared, but you can see how I would have this 1 day, 1 minute, 1 day, the 30 minute, and then I had this daily, okay? What am I doing here? Well, I'm looking to see how the bigger picture is playing out. What is that bigger picture? All right, we looked at the NASDAQ, and this is something that I highlighted to 10 Stock Trader subscribers this morning. We saw the NASDAQ futures. Let me go back to that real quick. This actually made a new high yesterday and today, right? You can see here, okay, made a slight new high. But the NASDAQ Composite Index, the cash index right here, did not, all right? Now, you might be thinking to yourself, well, Greg, I don't see the 5 waves move down here. Well, this is where we've had this correction that's kind of been boring. Not a lot of activity, a lot of activity back and forth, but no breakdown, no breakout. So, but within that framework, you can see I'm still looking for a 3-wave move. Okay, so my thinking is that we have this. This is an A wave, and then this is some type of complex B. I mentioned Gann Analysis, the time. Okay, and you can see down here in the bottom right-hand corner of the chart. February 21st, which is coming up, and then the first week of March are important short-term time frames for me that I'm watching, okay? And that would be, where we could possibly see this B wave. Now let me expand out. This is where we would see a C wave, and if you're a 10 Stock Trader subscriber, I'm looking at March, possibly into April, okay? as a very, very important inflection point. I'll get into why that time analysis is important in further shows. I'm not going to get into Gann analysis all that much right off the bat. I want to cover Elliott Wave and some of the other technical things first, okay? But so basically what I'm looking at here is this whole correction from A, B, C, you know, off this move in August, okay? We're likely to have this correction, and then we're probably looking at a chance to buy. All right. So when we look at Elliott Wave, we're looking at the smaller picture, we're looking at the bigger picture. All right. But what else are we looking at? We're also looking at other sectors. We're looking at other indexes. We're looking at other stocks. Okay. So maybe you don't want to trade the NASDAQ futures. You don't want to trade just the NASDAQ. You want to trade, or you don't want to trade futures, but you just want to trade the stock. You don't want to trade, you know, you don't want to have that type of leverage. You don't want to trade the options. That's fine as well. If you're going to be trading a specific sector, okay, like the NASDAQ, okay, I would look at the NASDAQ futures, even though you don't trade them, I would have them up. I would look at the NASDAQ Composite Index. I just showed you that. I would look at the NASDAQ 100 Index, and I would look at the Spider Technology Sector ETF, which is XLK. All right, so I would have all those up in these type of screens, and that's what I would be tracking all day, every day. I would also be looking at what are the biggest stocks within that sector. I'd be looking at Apple. I would be looking at Microsoft. I would be looking at Amazon. You know, all right, let's look at those. So if I looked at Amazon, it's one of the strongest. It has been, it's had a nice run, right? Okay, and now we can see we had this correction. Now, if you compare this to the NASDAQ chart we just looked at, and look, I'll get out of this and show you just a bigger chart, okay? So if we compare these two, right, and the NASDAQ Composite Index relative to to Amazon, Amazon has had a nice trend up, okay? Topped here on February 4th, all right? But NASDAQ futures has made a new high, but NASDAQ Composite Index, this is what's known as divergence. And I talk about divergence all the time. When something isn't lining up, doesn't mean that you can't see a rally or a decline or whatever it might be, but it's not, it means that there isn't enough momentum for everything to be following the same path, right? So go back to COVID-19 and when you had this drop into March 2020, everything bottomed and rallied at the same time, right? You had that momentum. That was as clear as day. Now we don't, okay? Amazon is trending lower, okay? So if you think about that relative to the NASDAQ, now let's look at Google. Okay, and Google, there we go. So Google is doing the same thing, right? This topped back on the 4th and it's dropping, okay? Not the same momentum as the overall index. That, you know, it doesn't mean that you can't be long the NASDAQ and make money. I'm not saying that. My point is from a bigger perspective, a swing trading perspective, this is where it gets important. Let's look at Apple, all right? You know, same thing. This topped out on last December, okay? Huge move down, and then we have this rally. So now let's think about December, or I'm sorry, later this week and then into March 5th, okay? This is actually a really good real-time example. If you're looking at this and you're only thinking about Elliott Wave, what are you looking at? I'll tell you what I'd be looking at, okay? Is this the first leg lower? And let's look at it from exactly what we just learned, basic Elliott Wave, okay? Is this 1, 2, 3, 4, 5, A, B, C? Certainly looks like it to me, okay? So where would you be wrong? All right, if you wanted to get short up here, let's say this makes the new high, okay, and you just wanted to get short Apple, where would you cover? You would cover at the all-time high. Now that's kind of a big spread, okay? You might want to go with a smaller position, but that's certainly a trade that would make a lot of sense, okay? And if you think about what I said earlier about, you know, March, April possibly being a bottom, then what will we look at? Well, let's look at a longer-term time frame of Apple, okay? And what we can see here, all right, and I have some other things. And look, I mean, I didn't even plan on having this up today, but this is great. Look, I have this 1, 2, 3, 4, 5, and then we had this correction. All right, so we can kind of see, and this is a longer term weekly chart, but what would make the most sense for Apple if this is the case? This would actually, so wave one down, all right, but if you look from this top, but if you look at it from a longer term perspective, right, Apple's been rallying. So then take the longer term trend into account. This would likely be an A, and then this would be a B, and then if we think about that March-April time frame, and whether it bottoms in late March or late April, I don't really care. If you're thinking about the long-term perspective, this is likely to be a buying opportunity. Okay, so this would be A, B, and then we get this C. Again, if this isn't making a whole lot of sense because I've thrown a lot at you, but you'll start to see how these wave fives and wave threes and ABCs all start to play into each other. All right. So I think that was a real good example of Apple, real-time example. Okay. And again, I'll zoom in on here so you can see 1, 2, 3, 4, 5 ABC. You know, oftentimes you'll see these new highs. There'll be stops. There'll be a lot of volatility around it. So maybe we pop up. That happens at the end of this week, March, and and then we get this considerable drop. That's something I'm going to be looking at. All right, let's take even more of a mess with Microsoft. Now again, we look at Google, Amazon, Apple. This is Microsoft. Okay, this has been a complete mess, right? But you can see here, I have all these different labels on here. I'm doing this every single day, literally every minute of every day. I'm trying to figure out what's the smaller picture, and how does that smaller picture lead to the bigger picture. All right. So Microsoft, topped out in July. Now here's the other thing. I mentioned COVID and how we had this momentum and everything moves in tandem. Going back to last year, we looked at a lot of different things. I was looking for a lot more volatility than I thought we would have, but what I did see is a lack of follow through between Microsoft. I'll cover SMH in a bit. Semiconductors, and it told me to be very, very cautious. Everyone was very, very bullish, and it was, that was telling me, look, guys, it took a little bit longer than I thought, but the divergence I'm seeing doesn't mean you just go blindly long in, and start buying everything with both hands. It's not what I wanted to do, and that turned out to be the case. Okay, so you can kind of see where I have here. This is where you get into more complex corrections. And if you buy that Elliott Wave Principle book, it'll get into complex corrections. I'm not going to get into that right here. But if we take into account what's happening with time and then the price, this should be setting up for a bottom, whether that's late March or late April, doesn't really matter to me, when I think about the longer term picture. But if you think about the divergence between what the NASDAQ doing, Apple, Amazon, Google, okay, it's just not all lining up. There isn't the momentum right now. So this is where I think understanding how time plays into it is also very important, okay? So that's tech. Now let's say you didn't want to, you wanted to trade semiconductors, or you wanted to trade industrials, or you wanted to trade the banks. Or you wanted to trade bonds. I'll get into bonds in a minute. What would I look at? All right. So let's go to semiconductors, and within semiconductors, I'll get these out of the way for now. All right. So we look at the VanEck semiconductor sector, SMH, and this is very, very similar to how Microsoft is trading, which I find interesting. But this is also where I love Elliott Wave, because if I can see, Microsoft isn't a semiconductor stock, but it looks very similar to what's happening in SMH. So they're going to line up in some capacity. All right. So if I were to look at SMH, what are the top ones within SMH? We look at NVIDIA, just like I did with the NASDAQ, and then we look within it. Okay. We looked at Google, we looked at Amazon, we looked at Microsoft. All right. NVIDIA had this double top. We're looking at probably another complex correction here within NVIDIA. We can look at Taiwan Semiconductor, okay? Same thing, okay? Not breaking out. We can see it top down up here on late January, okay? And now we have this, let's see how this plays out, but this could be something in the Elliott Wave terms where, okay, this is an A, and I'll zoom in here. All right, this is off this top and resistance. This is an A. This is a B. we'll see what happens here over the next couple of days or weeks, and then we get this C wave, into March, April. That would be something to buy. All right. So that's my base case. Let's say you wanted to trade industrials. Okay. So we look at the Dow, and then this is the daily picture, but you would then log into or dial down into the 1 minute, the 30 minute, the 120, and you can pick whatever time frame you want. All right. But this is, I think this is helpful to be able to, depending on what you like to trade. You'll also figure out that, I don't like to trade the NASDAQ, I like to trade the Dow. Or I don't like to trade the Dow, I like to trade the Russell 2000. Or I don't like to trade stocks, I like to trade bonds. Or I don't like to trade this, I like to trade silver or gold or cotton or whatever it might be. You'll figure out, and a lot of it will be based upon, how you see. Some Elliott Wave patterns are clearer than others. I get questions all the time, how come you didn't trade this? How come you didn't trade that? For whatever reason, my eye tends to catch certain stocks and indices better than others. It's just the way it is. And I've learned to stick with what I'm good at, stick with what makes the most sense to me. So and that might be different for you, which is great, but you'll start to see how those things work. So within the Dow, I'll look at something like JP Morgan, which is the banks have had a nice run here, but the Dow's not breaking out. And then you would look at something like Caterpillar, okay? And you can see Caterpillar, and this is pretty interesting that after the election, Microsoft or Caterpillar topped out, or it had a huge gap higher, as you can see here, rallied, and then we had this move lower. So if we're going back to the Elliott Wave, what does this look like? What am I looking at in terms of an Elliott Wave count? I mean, you can kind of see it here going back to the low in 2023. All right, so this is a daily chart. So let's see the basic one, two, big three may move up, 4, and then 5 was that top. Okay, so and you can see it again. 1, 2, 3, 4, 5. All right, so what is after 5? What do we have? We have a 3-wave move. Okay, and when we look at a 3-wave move and we factor in time, I think this is a really great chart, kind of just like Apple. All right, in real time. Okay. This to me looks like an A wave. We have this B wave, okay, and now we'll have this C wave. Now Caterpillar tends to move usually before other stocks kind of get the picture, if you will. So if I factor in March and April here, okay, what would this be? This would be an A, B, and then this C wave should most likely bottom out around that March, April time frame. And then what we have here is likely, over the course of the next 12 to 18 months, another 5-wave move higher. All right. But here's the other thing. And let's do a real-time example. Again, this is just an example. I'm not recommending this trade. But let's say we get something where Caterpillar does bottom out. Let's say we get something like this. Okay. All right. Now, there's a couple ways to play this. If this is the C wave that happens, and I'll make this a little bit bigger. The default is always minimum, and you can't change it. All right. So if this is a 5-wave move up, 1, 2, 3, 4, 5, okay, and then we have this C wave move correction. What are we looking at here? If we buy here, all right, maybe we put our stop here. If you were trading just a stock, but this is again just whether you're trading futures or stocks, whatever it might be, the rules still tell me the same thing. ABC, I'm going to buy here, and if I'm wrong and it goes below this, that's 307 level, that's where I'll put my stop in. But you have a really good risk reward, right? Let's say it drops into 325, 330, I have a stop below 305, but my profit, okay, my price target is a new high above 420. That's a nice trade, all right? Something to be looking forward to in March and April. Okay. We have about 15 minutes left. I'm just going to cover. I wanted to nail home Elliott Wave, and trust me, I'll be talking about that every single show. But I wanted to give you both short term, longer term. Again, I know it's like drinking from a fire hose. It'll start to make more sense, I promise. All right. But I also want to cover some of the indicators, and I'm just going to cover a couple of these, okay? And when we talk about, and I don't care if you look at RSI or composite index like I do, or the MACD, as I mentioned, there's a ton of other momentum indicators, lots of technical indicators, okay? But what I like to focus on are divergence and something called reversals. Most people have heard of divergence, all right? And I'll give you a real-time example of this. This is the U.S. 30-year index, okay? 30-year interest rates, okay, in the U.S. So this is divergence. It's really quite simple. When prices are rallying and you notice that the RSI right here, okay, starts to diverge, meaning the RSI is making lower lows and lower highs while price is actually making higher highs, that's a warning. It doesn't happen, what's the signal? The signal is it's a warning. It may tell you maybe take some profit, or reduce your position size, maybe wait a little bit. It's not as definitive. And it can, as you can see here, okay, this divergence started this was the first lower high that started in October of 2023 of 2024, excuse me. Okay, and that lasted, for a whole month while prices were chopping and made a new high. Eventually, you can see that was a warning sign that prices were falling. Okay, so it's not as strong as some other signals. Well, what is a strong signal? This is where things get exciting. These are the type of signals that I love to find, and they don't happen all that often, and they're called reversals. So there's divergence, and then there's reversals. Reversals tend to be very sharp, and this is what we had here. Okay, so a reversal, and it takes a while for your eye to catch it. It's the opposite of divergence. Okay, and so what we're looking at here. These are the same 2 points. So this is back in December of last year. Okay, so I took this point on the price chart and this point on the RSI. Okay, and when I saw 30-year interest rate drop into this support level, all right, I noticed that on the same 2 points on the chart, okay, the same 2 points, the RSI had made a lower low while price had made a higher low. That's the reversal. That's the signal. All right. I pointed this out to 10 Stock Trader subscribers. We bought TLT puts, which is the inverse of interest rates. Okay. So you can kind of see it here. You can't kind of see it. You can see it. All right. So these same 2 points made a higher low, while the RSI, and I'll highlight this for you now, the RSI made a slight, you can see it though, a slight higher high. That was the reversal. We bought TLT puts, and we covered them in a few days for a nice 35% gain or something like that. So you can see reversals are very, very sharp. And again, they don't come around that often, while divergence tends to take a little bit more time. So that's a really good example, again, real time, using a real trade, of where to look for these reversals, and then also look for divergence. Now, how else can we use what's happening with divergence and reversals? Well, this is where we can incorporate Elliott Wave. Where within the framework, where within the rules can we see that we have an RSI reversal or divergence, and then what does that mean for the bigger picture, right? So let's go back to this caterpillar for a second, all right? And let's say that I'm right, that this is a big ABC, okay? I think this is important too. What am I looking at here in caterpillar that seems is it divergence? Is it a reversal? Well, look, we can see here at the bottom with the composite index, this is actually starting to slope up while prices are dipping lower. So if we get this C wave in here, what am I going to be looking for? Is this divergence in the RSI is it going to be making higher lows? Okay, is the composite index also going to be doing the same thing? Do we have that divergence where price, right? Let's say it's not as volatile as this, but you know, it makes it a new low, wherever it might be, and we have divergence there while into a time frame. That's something that I think is going to be a buying opportunity. And here's the other thing: if we see it in Caterpillar, we'll see it in the Dow. We'll probably see it in the Nasdaq, the S&P. So you know, I'm going to be looking for these different setups, you know, over the next few weeks to be able to trade. I do think that we have a little bit more volatility before we get there, but this is how I'm going to be using, you know, Elliott Wave and the indicators to for our next setups to trade. All right, so I think that's a good first 50 minutes of in-depth Elliott Wave and then some of the indicator stuff. Let me go ahead and take some questions, if there are any. All right, so let's see here. How many hours do I spend a day trading? Well, I just showed you. So I like to, you know, I usually get up around 4:30, 5:30, depending on, you know, kids, stuff like that. But, you know, I like to see what happened overnight. You know, I like to see what the futures markets are doing. And here's something that I'll say about trading. Most people have jobs. They have a career. Trading is a lifestyle. Investing is a lifestyle. It takes all your energy. You have to be all in, okay? You really can't shut it down. You know, I've gotten a little bit better of doing that, you know, because you kind of have this burnout effect. But, you know, there's, especially now, look, I mean, there's politics, there's, you know, trade wars, there's stuff happening on the weekends, there's a change, and, you know, and how is that going to affect what's happening in the market? So, you know, it's an all day, everyday thing. For me at least, and I can't speak to anybody else, but this is kind of how I learned, you know, for the first hedge fund trader that I worked for, and then, you know, throughout my career on Wall Street. So it's you know, you have to be all in. So it's an all day, everyday thing. And if we go back to, you know, the 1 minute, 1 day chart of the Nasdaq or whatever market you're looking at, again, those are my building blocks. So every day I'm putting each building block together, each puzzle together. And sometimes you get it wrong. Then you got to start over. All right, what is this telling me? What's the setup? What are the rules telling me? Okay. Can you buy CAT here on tariff fears, or is that too risky? So I can't tell you what to buy or not. I kind of went over the setup of what I would, or what I'm looking at. Tariff fears is interesting because what it might actually happen is that there is so much fear and the market will actually do what will hurt the most people. So everyone wants to sell because of all these tariffs. Maybe they're not as bad. Maybe they're actually good. You know, if my thinking is if Trump can do the tariffs while cutting the budget, while getting interest rates lower, which would also be effective with budget, and cut taxes, that would be a good thing. So that would be, you know, the fundamental aspect. Here's another thing of technical analysis, and if you're a 10 stock trader subscriber, you've heard me say this a million times, but I believe that price comes first, fundamentals come second. Okay, what does that mean? I know it's kind of weird to say, but basically it goes back to Elliott Wave. It goes back to the price action. It goes back to human emotion, investor emotion expressed on the chart. How do I look at that? What is it telling me? Okay, if this is telling me that there's fear, okay, and it happens to be in an ABC correction off of this big move, right? Okay, then, you know, this is probably a spot to buy. I'm going to buy what, you know, is a contrarian trader. I'm going to do what everybody else doesn't want to do. So that's kind of where I am with CAT. What have you found to be the most profitable trading time frame? Day trading or swing trading? You know, there are some firms out there who will only trade the first 30 minutes of the day, and this is obviously day trading. You know, that to me, I think limits your potential for what you can have. It can also increase your risk, no doubt. But like I said, I like to have the bigger building blocks. So particular time frame, you know, during the day, obviously the open's going to be important, and then you have, you know, any type of catalyst. But there's an old saying that, you know, amateurs buy on the or trade on the open and professionals trade on the close. I don't necessarily believe that. it's you'll have a lot of volatility on both. So that's if that's where something that you wanted to look into, do some research on it and see. I don't like to think about that because then it kind of gets in your head like, oh, well, what's happened on the open, what's happened on the close, and then I got to do something. So that's I don't. To me, the entire day is open. That means there's opportunity. That's maybe that's the optimist in me, but that's kind of how I look at things. Um, are there any asset classes or sectors you believe are ripe for trading opportunities now? Yeah, well, it kind of goes back to there's always the next trade. Always. There's always going to be another trade. So for me, and I tend to look at stocks and bonds the most, it's, how this tariff situation plays out. I've mentioned on almost all of the charts that we've looked at today, this March, April timeframe. If you're a 10 stock trader subscriber and you follow me since, late fall last year at least at a minimum, we've looked at this from a timing perspective, from a cycle perspective. Okay, so there's always going to be opportunity, and I think right now, but what's happening with stocks and bonds is very intriguing to me. I'll also show you what is happening with bonds. Okay, so you can see here, this is going back to 2023, October. All right, I have this labeled here. This was the bottom in stocks, okay? We had this big drop down in bonds. Everybody got scared. Interest rates were rallying. That created the bottom. Well, you can see here, okay, we've had this downtrend in bonds. Now, some of this has been, some stocks have rallied with interest rates because they think that the new president and the new agenda is going to be growth oriented. Fair enough. But what we did see is when the Federal Reserve back in December said, hey, look, we're not going to be cutting as much, bonds tanked and stocks basically topped, kind of went sideways. So my thinking, and if you think about this from a bigger picture, okay, if we have another drop in bonds similar to what we saw back in late 2023, where bonds tank one last time, not one last time, but within this cycle, okay, and we have another, I don't know if it's going to make a new low. If it doesn't make a new low, it doesn't really matter. But if we see this bond move happen into that March, April timeframe with stocks, and it's on fear, some type of fear event, again, whether it's, nobody likes to talk about war, but it's unfortunate, but that's part of the world we live in now. Is it something with Ukraine, Russia? Is it the Fed? Do inflation's numbers, not looking good, whatever? That could create the fear. That could create the low in bonds and stocks. So that's something I'm looking at. Well, I haven't used strangles for some of the boring sideways stocks. So I like to use strangles and straddles when it's actually more volatile. Now, I used them in around the election, and we just didn't see that much volatility as much as I thought anyway around the election. So I tend to use those only in very certain situations. I like to see extreme volatility with strangles and straddles. You can sell them during those boring times, but I don't sell options in the service. I only buy, and that's actually a pretty good segue. Why don't I do that? I get it all the time. And Doc and Daily Wealth Trader, and there's plenty of other services that sell options. They take in the premium, they take the structure of the option and use it to their advantage. If they sell an option, they're going to get the premium, and then time decay takes it out. I get it, totally understand it. I'm not saying don't do it. But for me, what I like doing is I have a timing mechanism with WD Gann, okay? So that allows me, and it's not perfect, I'm not perfect, no one is, but it allows me to have a better probability of timing the market, okay, and using long options. Most people say, well, you use long options, the time decay is the opposite. It's going to hurt you. This is true. But what else does it do? And this goes all the way back to the start with Paul Tudor Jones and the risk management aspect, okay? It all filters through with Elliott Wave, time, and then trading long options. What do I mean? By buying an option, your risk is automatically in place. So if you spend $500 on a TLT put, that's your risk. That's the most you can lose, okay? So that's why I like to buy options in this service. So we have a hard stop at 2 o'clock. Thank you for joining. This was the first show, hopefully one of many more. And if you have any other questions that you want to ask next time, please feel free. You know, I like the interactive nature of this. Okay, and I'll continue to talk about the three tenets of technical analysis. And next week I'll also, just as a heads up, you know, look at how to use Fibonacci retracements and confluence Fibonacci zones in addition to what we looked at today. All right. Thank you very much. See you next week.